Filing for bankruptcy is a big decision that can affect many aspects of your financial life, including your ability to get or keep a mortgage. If you're wondering how bankruptcy impacts your mortgage and what steps you can take to recover, you're in the right place. Let's break it down and explore your options. First, there are two common types of bankruptcy, Chapter 7 and Chapter 13. Each one has different implications for your mortgage. Chapter 7 bankruptcy is often called liquidation bankruptcy. It's designed for individuals who don't have enough income to repay their debts. While this process discharges most of your debts, your mortgage lender still retains the lien on your property. That means if you don't keep up with your mortgage payments, the lender can foreclose on your home. However, exemption laws may allow you to keep your home if your equity is below a certain amount. The specifics depend on your state, so it's crucial to check your local exemption rules. On the other hand, Chapter 13 bankruptcy is known as reorganization bankruptcy. Instead of wiping out your debts, it allows you to create a repayment plan that lasts 3 to 5 years. This option can be beneficial if you've fallen behind on mortgage payments because it lets you catch up over time. However, you must continue making your regular mortgage payments to avoid foreclosure. Now, if you've already filed for bankruptcy, how does that affect your chances of getting a mortgage in the future? The waiting period depends on the type of bankruptcy and the type of loan you're applying for. For Chapter 7 bankruptcy, FHA loans require a 2-year waiting period from the discharge date. Conventional loans typically require a 4-year waiting period. Jumbo loans may require 4 or more years depending on the lender. For Chapter 13 bankruptcy, FHA loans may be available just 1 year after filing, provided you've made 12 consecutive on-time payments and have court approval. Conventional loans require a 2-year waiting period from the discharge date. Jumbo loans often require 4 years or more. If you're currently in Chapter 13, you might even be able to get a mortgage before your bankruptcy is discharged, as long as you have court approval and have made consistent payments. Rebuilding your credit after bankruptcy is essential if you want to qualify for a mortgage. Start by making on-time payments on all bills, keeping your debt low, and using a secured credit card responsibly. Lenders want to see financial stability, so showing that you've made improvements since bankruptcy can make a huge difference. If you're already a homeowner and struggling to keep up with payments, bankruptcy might help you avoid foreclosure, especially under Chapter 13, where your repayment plan can include past due mortgage payments. However, if you stop making payments after filing, your lender can still foreclose. For those considering refinancing after bankruptcy, it's possible, but comes with challenges. You'll need to wait for the required period, rebuild your credit, and meet the lender's qualifications. FHA and VA loans tend to have the most lenient guidelines for borrowers recovering from bankruptcy. At the end of the day, bankruptcy doesn't mean homeownership is out of reach. Whether you're looking to keep your current home or buy a new one in the future, knowing the waiting periods and taking steps to rebuild your credit will put you in a stronger position. Visit jvmlending.com for more info or to talk to a mortgage expert directly.